Hey guys, it is Julie here with JT Wealth. In today's video, we are taking a look at two stocks that are trading low, but that analysts think could be a great buy. So let's get into it. Alright guys, welcome back and thank you so much for being here. Now today, doing my research, I came across an article on one of my favorite resources, tipranks.com, on two stocks that are flirting with a bottom, but analysts say buy. And in this, they highlight two stocks that are down overall this year, but that analysts still rate a buy and have some pretty attractive upside. So in today's video, we're going to take a look at both of these companies, what their stock is doing, and what analysts' outlook for their future is. Just before we jump into all that, this is just your friendly reminder that if you enjoyed today's video, make sure you give us a big thumbs up and a heads up that as we approach 30,000 subscribers, I've decided I'm going to plan another live stream to celebrate. So we'll do a Q&A where we can sit down, have a glass of wine, and get to know each other a little better. So please leave your thoughts in the comments down below as far as scheduling and timing goes and what works best for you guys to jump in on the live stream. And of course, if you enjoy free stocks, don't forget to check out some of the links in the description down below. This includes Webull, who right now is giving away 4 free stocks for signing up and funding a new investment account. So make sure to check them out. All right, now when it comes to investing, there is the age-old piece of advice of buying low and selling high. And that sounds simple and great, but what isn't so simple is identifying when a stock has actually hit its lowest low and if that is actually a good time to buy that company. Prices fall for a reason, and sometimes that reason is fundamental unsoundness. Fortunately though, Wall Street analysts are busy separating the wheat from the chaff among the market low-priced stocks, and some top stock experts have tagged several equities for big gains. So these stocks are trading low now, but the reasons are not necessarily bad for investors. So the first company we're going to take a closer look at is Digital Media Solutions, who trades under the ticker DMS. Digital Media Solutions is an ad tech company which connects online advertisers with customers through performance-based branding and marketplace solutions. DMS boasts a powerful consumer intelligence database, which it uses to fine-tune customer acquisition campaigns while offering advertisers accountability for their project budget. Taking a look at their investor presentation, they have a significant and growing brand name roster of blue chip clients across diverse verticals, including e-commerce, home security companies, health and wellness, consumer finance, education, but also an emerging insurance focus with 10 of the largest U.S. insurance firms across auto, home, life, and health. And they also boast a healthy 90% customer retention rate across their portfolio. Their platform is built to solve 8 common advertiser problems, and for the sake of time, I'm not going to cover all of these, but just highlight that they are able to track return on investment as they provide a linear connection between the ad spend and results, which also ties in for their pay for performance model, so there isn't any waste with scaling campaigns, and their ability to quickly pivot if there is a campaign that doesn't scale, so they can edit and optimize quickly. Unlike some other well-known ad tech outfits, DMS is vertically integrated. It builds long-term relationships directly with organizations and uses various technology platforms to advertise and drive customer conversion for its customers. Now, believe it or not, digital marketing exceeded the traditional variety for the first time in 2019. That's changing in dramatic fashion amid the pandemic this year. Speaking with DMS founder and CEO Joe Marinucci, he said his firm is busier than ever. Digital promotions just got a massive bump this year, and that's unlikely to disappear once the dust settles. DMS went public this summer via a reverse merger with SPAC company Leo Holdings, and I know we're all getting very familiar with SPACs as this year is just blowing up with them. So they just came to market this July. These shares started trading at the $10 mark, but definitely saw some volatility right out the gate. Shortly after their debut, they hit lows of about $6.32. We saw a bit of a rise after that, but for the last couple of months, they've been trading primarily around the $7 price point. Today, we have seen them take a fairly impressive jump up nearly 27% to $9.26 per share. In November, DMS had their Q3 earnings report, and their quarterly revenue hit a company record of $82.8 million, which was up 10% sequentially and 44% year over year. Of that total revenue, the company saw a gross profit of $25.1 million for a 30% gross margin. All in all, DMS's first quarter as a publicly traded company showed strong results. Covering the DMS stock for Canaccord is analyst Maria Ripps, who is rated 5 stars by TipRanks and stands in the top 1% out of more than 7,100 stock analysts. She said that the company saw meaningful volume growth from both new and existing clients, with particular strength from its auto insurance business, along with the e-commerce, education, and nonprofit verticals. We continue to think investors will gradually come to appreciate DMS's similarities with other leading digital marketing peers that trade at more premium valuations and expect multiple expansion over time as the story becomes better understood. To this end, she rates the stock a buy, and her $15 price target suggested an upside of about 106% from $7.20. Of course, that percentage isn't quite as high today given their impressive rise in price. Now, there is one other analyst who has a rating on the DMS stock, and they also rate it as a buy. The average price target comes in at $14, which as of their price at $9.17 represented about a 52.67% potential upside. The second company that we're taking a look at is VSAT Inc. They trade under the ticker VSAT. VSAT provides customers with high-speed broadband access through secure satellite network systems. For home internet, they are now the fastest home satellite internet in the US and are growing globally. But more importantly, they have a big presence in the defense and security and aviation services. So what they describe is a very resilient and diverse broad portfolio of applications between defense and maritime to enterprise and in-flight internet, and are seeing some real powerful government growth factors, from Department of Defense cloud services and AIs to growing near-peer threats. You can see their revenue over the last decade has increased quite substantially. Now, the coronavirus lockdown has hit VSAT's stock particularly hard, and you might think that's a bit counterintuitive, as how on earth did internet demand go down during this pandemic? But it is due to the fact that VSAT has a large portion of their business in partnerships with airlines and their in-flight internet that they offer. So with airlines being grounded, that was a big hit to their business, and they've yet to recover from some of those previous year lows. Trading at $34.41, VSAT stock is still down over 50% from their previous highs up around the $74 price point. On a positive note, and one that is indicative of the essential nature of secure satellite communications in today's networked economy, VSAT reported $577 million in Q3 contract awards, representing a 29% year-over-year gain. For the year to date, the company has seen awards totaling $1.9 billion, which is up 5% from this time last year. Now, the third quarter revenues and earnings were somewhat mixed, reflecting both the increase in contract awards and the decline in airline business. Revenues were $554 million, down 6% year over year, but up almost 4% sequentially. Earnings per share was 3 cents per share, beating the predicted 5-cent loss by a wide margin. Covering the stock for JP Morgan is 4-star analyst Philip Cusick. And writing on VSAT, he said that we believe long-term growth levers remain intact, highlighted by record segment backlog of $1.1 billion. We view VSAT as a satellite innovation leader and believe the company's future VSAT 3 fleet will accelerate growth in satellite services over the coming years. At the same time, we see a long-term government systems tailwind driven by the company's radio portfolio, mobile broadband, and SATCOM. In line with his bullish comments, he rates them a buy with a $60 price target, implying about a 72% upside on the 1-year time horizon. Altogether, there are 5 analyst ratings on the VSAT stock, and it comes in as a moderate buy with 3 buy ratings and 2 holds. The average price target is $55 per share for a nice 60% potential upside. So there we have 2 different companies that are definitely down on the year, but certainly have some bright outlook ahead of them. And with that jump that DMS stock took today, they might be on the road to recovery sooner than we thought. Now, you guys know that I always love hearing from you, so please let me know your thoughts on these two stocks in the comments down below and any other stocks that are catching your eye lately. I always love hearing from you. And just a reminder that these videos are never a suggestion to buy or sell any specific stock. Any investment choice or trade should always be done based on your own due diligence and research. If you made it all the way to the end of the video here, make sure you give us a big thumbs up and that you're subscribed to the channel as well. Thank you guys so much for watching. I hope you have a fantastic day, and cheers.